What's up everybody, Investing Club here. In this video, I want to talk about a topic that I don't think people talk about enough, and that is when to sell your stocks. The question of when to sell your stocks and take profits is probably one of the most difficult parts of investing. It's easy to know when to buy in most cases, but it's not so clear if you're making the right decision to sell. So let's dig a little bit deeper and try to find an answer to this question. And we can start off with the question, when you buy a stock, how long should you be aiming to hold it for? And the answer to that is, if you buy a stock, you should be aiming to hold it forever. Now, in reality, this doesn't happen much of the time, but when you buy a stock, you should be so confident in the company that you're willing to hold the stock for your whole life. Warren Buffett says our favorite holding period is forever, and he also says things like, if you don't feel comfortable owning a stock for 10 years, you shouldn't own it for 10 minutes. And this is absolutely the mindset that I follow. You can also think about it as, if you buy a stock and the stock market closes down for 10 years, would you be okay with that? For example, all the stocks I'm invested in now, I have complete confidence that if I wasn't able to touch them for 10 years, after that 10 years were up, those stocks would be considerably higher than they are now. And even though I'm about to get into a couple of reasons why it might be a good idea to sell, you should always be aiming to hold your stock picks for the long run. That has been proven time and time again to give you the best investment returns. And we can take a look at that. We can take a look at stocks like McDonald's over the long term. In the past 40 years, up 21,000%. We can look at companies like Apple, and we can look at American Express. And this shows you can invest in these companies when they started out, and you don't even have to have invested a large amount. But if you just held until today, you would be set for life just because of how extraordinarily these companies have performed. Before we get into reasons why we should sell, maybe we should start by saying some reasons not to sell. And the most obvious reason not to sell is that the stock price goes down. Now, when prices fall, many novice investors get scared and run out and sell the stock. What we have to remember is the price of a stock isn't always equal to the value. Stock price of a company falls 10%. You have to ask yourself, did the valuation of the company actually change 10%, or are people just acting irrationally? And the vast majority of the time, people are acting irrationally in the short term. In the stock market, in the short term, is driven by fear and greed. And just because the stock price falls, you should not be selling. In fact, you should be doing the opposite and be buying more. To do well in the stock market, you have to act differently from the majority of people. And by definition, that means when most people are selling, you should be buying. In addition, when there's bad news coverage or bad media press about a stock and the stock is beaten down, this is actually one of the best times to be buying, because this means it's a stock because it's probably at its lowest point and will probably only go up from here. So in this video, I'll be going over 3 reasons why it might be a good idea to sell a stock. The first reason is that the business fundamentals are deteriorating. What I do is I only invest in incredibly high quality companies that have a solid track record and are projected to continue to grow many years into the future. And I wouldn't want to be invested in a stock that was expected to decline in quality. So if this happens with a stock I'm invested in, I might consider selling. Now, so a couple examples of business fundamentals are falling earnings, a company taking on excessive debt, and management making bad decisions. For example, the management making bad decisions. I know the management team at Occidental Petroleum just overpaid way too much for a deal to acquire another oil company. I forget the exact name, but I know they overpaid. And if I was invested in that company, I would not be supportive of that, and I would take a hard look at the management team and see what their goals are for the company in the long term. For falling earnings, a couple years of earnings, of underperformance on earnings isn't a big deal, but you need to watch your stocks closely to see if earnings being down are just a temporary thing, or if they are a reoccurring trend. And I like to show this example. This is the stock of Ascena Retail Group, and the orange line represents the earnings of the stock. And what you see is, all the way up until 2012, this company was performing very well, and the earnings were growing. And you could have bought it up here at $400 and said, I'm buying it at fair value. But what you see after that is the earnings start to decline very rapidly, and by the time 2018 comes along, they're not making any money. This is an example of if you held the stock all the way through this, you'd be left with practically nothing. And that's why it's important to keep on top of the companies that you're invested in. And if you think that earnings are going to continue to fall like they have been, then it might be time to get out of the stock. Reason number 2 is that the stock has reached or exceeded its fair value. And I think this is the one that most people disagree with. And I will start off by saying that a stock being at its fair value is usually not, a great reason to sell the stock. Because in reality, a stock can go much higher than its true value. And if you hold a stock for the long run, the fair value of the stock will continue to increase as the company earns more money, etc. And so what I do is I aim to buy stocks that are undervalued and sell them when they are above their true value. You don't have to sell out of the stock 100% when it reaches fair value. Instead, you can use it as an opportunity to rebalance your portfolio and maybe take some profits and put it into another stock that you're invested in that's been underperforming. And you can also exit out of the stock over a period of time. So you could start by selling, a quarter of your position or half of your position and waiting to see what the rest does. Now, something I usually do when I'm looking to exit a stock is I look at the trend that the stock is in. And I'm no expert on trend following, but a very simple way to tell the trend of stock is to look at the moving averages. I included a chart in this slide. This is a stock that I actually was invested in and recently sold out of. And the blue line on the chart represents the 50-day moving average, which is the average price of the previous 50 days. And what moving averages are they typically act as points of resistance for the stock. So anyone who knows how stocks move, they don't move in a straight line. They go up and down in a sort of wave pattern. And if a stock goes down and hits a moving average, there's a solid chance that it will continue to go back up if it's been moving up. However, if a stock breaks below a moving average, there's an increased probability that the drop of the stock will continue. And so this chart I have here is from stockcharts.com. It's of Align Technologies. They're the company that makes the Invisalign retainers. And I was invested in that. This is a stock that I was actually invested in. I bought them around this $170, $180 level. It wasn't in September, it was a few months before. But I held. And once it got around this $290 to $300 range, I felt that was fair value for the stock. And instead of selling right there, I decided to wait because it can always go higher. And what you see is this stock slowly declined below the 50-day moving average, and it was there that I decided to sell the stock because I saw that there was an increased potential for the stock to continue to go downwards. However, there's also another reason why I decided to sell the stock, which is reason number 3, and that is that you find a better opportunity to invest in. So this is pretty self-explanatory. So for example, I thought the Align Technology stock was fairly valued at, in January. And so I decided to sell my position once the price moved below the 50-day moving average. And I decided to put all of that money into another opportunity that I found, which was HIIQ, Health Insurance Innovations, which is another stock I've talked about a lot on this channel. And you can see the performance of these two stocks since I moved my money. Align Technologies has been down 20%. Meanwhile, Health Insurance Innovations has been up 50% since I invested in them. And yes, I did get lucky. I couldn't have predicted that this 50% move would happen right after I put my money in it. But this just shows sometimes it's a good idea to take some profits and invest somewhere else where you think there's a better risk to reward scenario. So just for some final thoughts, the decision to sell a position is, a very personal and individual decision. There are many different reasons to hold or sell, and it depends on your preferences. And there could be two people that are invested in the same stock, and one could decide to sell and one could decide to hold. And it could be a good decision for both of them based on what their objectives were. Deciding to hold a great company can pay off in the long run. I showed you those long-term charts of stocks like McDonald's. Even when the stocks fell, like during the Great Recession, if you just held on to them, you would be very well off today. And finally, you don't have to sell all of your position at once. You can always start off by selling 25%, 50%, or even as low as 10 or 5% of your position and slowly average out over time. If you have any thoughts, leave them in the comments section. I'll be sure to get back to you. And that's it for this video. So leave a like and subscribe if you learned something of value from this. And I'll be sure to see you on the next video. Bye-bye.